I believe that investing and knowing how to invest our money is something that everyone should know. It's like counting numbers, in my opinion. So everyone should have that a basic understanding of what investment means, what investing means, and how to properly manage their money to make their capital grow. You know, when we have a headache or when we have a little fever or something, we take some medicines, right? And we do know how to take those medicines because it's common sense, okay? Someone taught us that, maybe our parents or our doctor even taught us that. We didn't take any university courses, we are not doctors to take those medicines, but we still know how to take those medicines. And the same thing applies to investments. To invest your money, especially if we are talking about small capitals, I'm talking about 10, 20, 50, even $100,000, there is no need for a graduate degree or for anything complicated. It's just about taking the right medicine. So how do we decide which medicine is right for us? Well, in this video we're going to discuss how to take those medicines and which medicines to take. In this video we're going to discuss investments for people that start under zero. Hey, it's Dario and this is Divity Finance, a platform where we can share our best tips and tools when it comes to trading, investing, or finance in general. And if you love the subject, please consider subscribing. Let me start by saying why I want to make this video. Well, part of the reason, I just said it in the intro, but mainly also because if you try to go online and find information, you will see that there is a very hard time to find the simple information, cohesive information that essentially take the most easy parts of investment and the most crucial parts of investment and spit it out to you. That thing is kind of hard to do. A lot of times we see online big words and big things and big explanations and maybe even university explanation, when in reality everything should be easier. Investments should be easy. If they are not easy, then we're not doing a very good job. Now, of course, for certain things we need university, for certain types of capitals, for certain types of investors, then we need very professional people. That's why advisors are there, okay? And that's why we pay advisors. That we are also gonna talk about advisors. But in general, for the most part of people, for the people that maybe started out working now at 20 years old, at 25 years old, that have 10, 20, 30K to put into investments, there is no need for a university course. So in many cases we will also be able to do everything that we need to do by ourselves without even needing to ask to an advisor. So let's see in this video. Also, another reason is the general culture, you know, the general literacy. As I said before, I do believe that a certain amount of knowledge, of level of knowledge of investment and finance in general is a must, especially for people that are out of high school, even more for people that are out of university. There is no way you can get out of university without you knowing what to do with your money and how to invest properly your money. So in this video we're gonna talk about that. Now let's start with the definition of investment. What is an investment and what does it mean to invest your money? Well, investing means buying financial products that increase their value. Be careful because we are talking about value, not price. The two things are different. So we don't only need to increase, or we don't only want to increase the price of the product, of financial product that we buy, we want it to increase the value. Because in investments, the goal is not making money, but making your capital grow in value. I know these two things kind of seem strange. I mean, you say, okay, you want to increase your value, your capital value, which includes making money, but at the end of the day, you don't want to make money. Well, it's not exactly about not making money. It's more of a mental set, a mental thing that you do not want to say to yourself that you need to make money, but you need to increase the value of your capital, okay? Which That means very long times and being very patient, okay? So that's why when we talk about investments, we talk about the long term. Short term, anything can happen. Long term, that's what we watch. And of course, in investments, diversification is important, but diversification doesn't mean buying many stocks. Diversification means one thing very precisely. And we're going to see what diversification is, because it's not always what you think it is. Now, another warning is to be aware of the scams, okay? So the financial sector, okay, the financial industry is a very profitable place for scams, especially when we talk about trading, but also when we talk about investments. You know, taking money out of people is very easy. It takes a little bit of minutes, okay? We just give the IBAN, the codes for the bank, and we have the transaction, okay? So doing these scams is very easy. Also because you can play on the gambling aspect of people. You know, people have a tendency of gambling. Most of the people do, and people like making money, and people like the expectancy to make money. Okay, so the probability of making money, the desire. Okay, so people like money, even though some people don't like to say it, but we all love money, and that's why scams are very easy to do in the financial sector. So always verify by yourself, never trust anyone, not the independent advisor, not the bank advisor, and always ask yourself how that person is making money. Because if that person is making money out of selling me certain products over other products, then it's not good. So if you don't pay your advisor, always ask yourself how that advisor is making money, because at the end of the day, everyone needs to bring home the bread, and everyone needs to eat. So always ask yourself how those people make money. Now, why do we invest? To talk about inflation, we first need to understand our economy, okay? I said this video is for people that start under zero, so let's talk about our economy. What is our economy and how our economy works? Now, our economy, the modern economy that we built and that we all like and that we all use, okay, some people like it less, or some people like it more, we could change it, okay, but in general, that's what we have. Again, we could change it, yes, we did, we changed it for barter to what we have now, so we did change it in the past, but for a couple of 100 years, we have this, which is based on credit. What is credit? Credit basically means that our economy is based on giving more and more money. And that's mainly done through the central banks. Okay, so central banks more or less manipulate the economy and try to give credit to the economy itself. So it's called inflating the economy. So that's why we have inflation. Well, basically inflation, what does it mean? Inflation means rise in prices of goods. How do goods rise in prices? Well, there needs to be more money in the economy. If there is more money in the economy, every single unit of money, wherever it is, euros, dollars, yens, and so on, it's gonna be less valuable. So that is why our money, our capital, loses around 2% every year. 2% is a good goal that central banks like for seeing a prosperous economy, for seeing a growing economy. Credit is also responsible for the growth in our economy. That's how we grow, with credit. So taking loans and, taking mortgages even. And all these things make our economy grow. That's why in the long run, there is a tendency in the economy to grow. That's why if we invest in the main economy, so the world economy, we have a pretty good chance of seeing our capital raise in value. That's because the economy appreciates, okay? The economy rises in value. And that's why we ourselves, the population, becomes more and more wealthy. One thing to remember is there is no person in the world that doesn't invest, because the liquidity is still an investment. Now, later in this video, we will talk about liquidity as a non-investment, just to make things easier. But remember that the liquidity is a choice of investment. You are choosing to put your money in a certain currency. If that currency loses value, which will lose value around 2% every year, then you will lose your money. So in reality, when you put all your money in cash just because you are afraid of investments, then you are doing a bad investment which loses a 2% every year. So remember that. By the way, being afraid of investments, I saw a statistics in Italy. Italy is very bad at finance. Okay, they are in Italy. We are the country which is the least literate in finance amongst all the countries in Europe, and mainly the reasons why the people didn't want to invest is because they were afraid to lose money and because they didn't understand what investment means. So all these things are, of course, due to the poor in literacy about finance. But let's continue with the video. Let's talk about investments as an actual thing. So let's start talking about investments. Now, how do we do investments? Well, first of all, we need to understand that investments is a personal thing, right? If we go back to the medicine example, it's just like if people would need a different medicine, right? So investments are personal. That's the key thing that I want you to take away from this slide. Now, what does it mean again? It simply means that investments need to be suited around the person's needs and the person's characteristics. Now, if a person has $500,000 or $1 million, the investment portfolio will be completely different from another person that has the same amount of money. If the person has $10,000, the investment portfolio is going to be slightly different from another person that has $10,000. That's just because smaller capital needs smaller care and there are a smaller number of instruments that can be used, and so there is no need to go wild in the investment choices and make something very complicated if you have small money. But nonetheless, the investment is still suited on the person and it's still very personal. So when we do investments, there is a component of personality and there is a component of our needs that we're going to see later in this video. So we do need to understand our needs before investing. One other thing is that we do not have to adapt to the investments. I see many people, many groups, now I'm in an Italian group, but I see many people trying to adapt to the investment. What do? They simply go to the market. There is a simple website, at least in Europe, it's called Just ETF. We will see it later in this video. They go to the market and they just choose the best ETFs that are there. I'm talking about ETFs just in general. We will talk about other financial instruments. If you don't know what ETFs are, we will discuss it later in this video, don't worry. But what they do is simply choosing the perfect financial products. They see, okay, this product grows very, very fast. Let me choose this one, not counting their personal needs. So they will maybe go to an equity fund or to an equity product, financial product, and they will say, okay, let me invest here for 2 years. So the root of the problem is that the person didn't suit the investment for their needs, but the person changed their needs or their goals because they realized that if they want to do that investment, they cannot only put their 2 years. They need to put their 5 or 10 years, right? So that is very, very important. That is very, very dangerous to do. So never suit yourself to the investment that you wish you could make. Always suit the investment that you're gonna do on your personal needs. So knowing ourselves and understanding what are our needs and what are our expectancies and goals is crucial when we talk about investments. One of the first things that we need to understand is the time horizon or the time window, right? So how many years is the investment gonna be for? So how many years am I willing to put my money there? Or for how many years can I wait until I need those money? Okay, so also to understand that, we need to understand why we need this money. Now, when we talk about investments, we need to understand that money is not useful. We don't need money, right? We use money as a means of exchange. We don't eat money. We don't actually use money, okay? We use it as a means of exchange, which means that every investment has to have a goal. We need to know why we want to increase our capital. Do we want it because of pension? Do we want it because we need to put our children or our kids in university in some years? Do we need it for other reasons? Do we need it because we want to leave those money for our kids when we die? Do we want it because we want to buy a house? So all these things will then define what is our time horizon. If I want it for pension, then my time horizon is gonna be 20, 30, even 40 years. If I want it for buying a house, maybe my time horizon is gonna be 10 years. If I want it for putting my children in university, maybe it's gonna be for 18, 15, 18, 20 years, okay? And also, we need to understand what is our current situation. Of course, not everyone can invest. Now, don't be scared about having too few money. But of course, if you struggle to make ends meet, if you are the only person that makes money in your family of 5 people, and all those circumstances, then you need to understand what is the limit, how much money you can invest, and what is your actual situation. If you do need those money in 2 months, maybe it's not a good idea to invest your money. And that also comes down to the time horizon. Okay, so always understand yourself, what are your goals, what are your needs. Now let's talk about capital. Now there is a golden rule. I heard it being called a golden rule. I don't agree too much with it, but it simply says that 1/3 of your capital should be invested in gold, 1/3 of your capital should be invested in liquidity, 1/3 of your capital should be invested in stocks. Now, why don't I agree with that golden rule? Simply because it doesn't take into account your needs, as we just said. So 1/3 in gold, 1/3 in stocks, and 1/3 in liquidity. Where are my needs? There are no needs. So, generally, that's a good rule to say that simply you need to invest your money. Okay, so 66% to 100% of your capital should be invested, and that of course doesn't account for liquidity. As we said, we will consider liquidity as a non-investment. Also, remember that the goal is to protect your capital. Okay, protect it against what? Well, against inflation. We talked about it before. Okay, and also to protect it from what is so-called the specific risk. We will talk about that when we'll talk about diversification, so just wait. Also, the major rule that we should apply to understand how much capital we need to use is that we need to sleep at night. If we don't manage to sleep at night, which means that we think about our investments, we cannot fall asleep because we are worried, then there is probably a problem in how much we invested and how much we risked. So always keep that in mind. You should be able to sleep at night, okay? Which is actually something that may sound stupid to say, but it's not too stupid when you see people on certain forums or certain groups that are worried about what their investments are gonna do. How do we make money in investments? Well, of course we make money through the exchange of financial products, but we make money thanks to the compound interest. Now, what is the compound interest? Compound interest simply means using your past profits to make even more profits, right? So if this year we made $1,000 in profit, the next year we're gonna use $1,000 plus the initial capital that we invested initially, and then we're going to make even more than $1,000 the next year, and then even more than $1,000, and so on. Okay, now it is important to understand that compound interest works in the long run, not in the short run. And so we need to look at the long run. We need to look at the long-term perspective. Okay. Also, another thing is dividends. Dividends can be reinvested, and dividends are simply profit that we just reuse to make even more profit. Okay. Now, compound interest is very, very useful for all those people that have a small capital. What do I mean? I mean $100. If you have $100, you can invest. If you have $100 every month, you can just put it away and then invest those $100. Now, an advice is never to invest $100 every month because that gets very, very expensive. But maybe wait 6 months, wait 12 months, 18 months, and then you can invest that money that you accumulated, okay? So don't think that you have too few money, which is another reason why Italians don't invest. They say I have too few money, when in fact nobody almost have too few money to invest, unless, again, as I said, we cannot make it to ends meet, okay? But if we have $100 a month, we are able to invest our money, okay? So small capitals, even small capitals, make big capitals in the long run, thanks to compound interest. Another aspect to understand about compound interest is the initial moment when we start investing. Now, it is crucial to understand that small changes in the beginning, small changes in the difference in year in the beginning, will make a very, very big difference in the long run. So if we invest for 30 years or for 35 years, the difference is gonna be very, very big, even just for those 5 years. And that's just because of the long run and because of the long term of compound interest. Now let's start talking about practical things. Diversification. We hear diversification over and over. Everyone starts talking about diversification. It seems like everyone knows now what diversification means, when in fact, not many people do know what diversification means, and it does not mean putting all your eggs in different baskets, unfortunately. It means putting all your eggs in different baskets that are not connected by a chain. If the baskets are all connected by a chain, what does it happen if one basket falls? All other baskets will fall as well. So even if you put your money in one basket or 10 baskets, if they're all connected by a chain, there is no advantage in that. Your eggs will fall as well and will be broken no matter what. So it is important to choose baskets that are not connected by a chain. What is this chain? This chain is the specific risk. Now let's talk about specific risk. There are two risks in investments, okay? There is the market risk and there is the specific risk. The market risk is something that we cannot erase. It's simply the volatility of the general investment, of the general market, the up and downs of the market, okay? We cannot predict that, we cannot change that, we need to accept it, and that's why we make money. The specific risk is what we need to avoid using diversification when we invest our money. Now, every company or even every financial product or everything that we invest has some specific risks. Let me make an example, okay? Let's say we watch JP Morgan and we watch Bank of America, okay? What are the specific risks of those companies? Well, the specific risks are US market. Another specific risk is financial sector. Another specific risk could be, well, maybe the American continent. I don't know if that can be counted as a specific risk, but those are the specific risks, okay? Interest rates are a specific risk. Those are connected to the country they are based in, and so on, okay? They have an infinite number of specific risks. Currency exchange are specific risks, many specific risks, okay? What is the particularity though about those companies? That they are both in the financial sector, they are both banks, they both make money in the same way. Therefore, they have very, very similar specific risks. Okay, and if the financial sector doesn't go well one year, guess what happens? JP Morgan will not go well, and what other company will not go well? Bank of America will not go well. Now, what does it happen instead if I invest in JP Morgan and I invest in Amazon? What does it happen if the financial sector doesn't go well? Well, Amazon is not gonna be very impacted, okay? Amazon doesn't have the same specific risks of JP Morgan. Therefore, those two companies can actually make some diversification. If I invest in JP Morgan and if I invest in Bank of America, there is no diversification there. What diversification is that? If the financial sector goes down, everything goes down, okay? So the more we diversify, and the more we diversify with different specific risks, the more our diversification is gonna be actually efficient and useful, right? So if I invest only in the financial sector and I invest on 50 companies in the financial sector in the US, there is no diversification there. So let's try to make even another example. Now let's fly to Europe, okay? In Europe we can make maybe a better example talking about Europe and Italy, okay? Later in some minutes we will see how we can actually invest in specific countries or in specific countries or even in the global market without any specific stocks. But for now, let's imagine we invest in Europe and we invest in Italy. If we invest in Europe and in Italy, we will have what is so-called the correlation of around 0.8. Now, let's first talk a little bit about what is correlation. Correlation simply means how much two financial instruments move similarly in terms of prices, and those things reflect how much the specific risks are connected. Now, a 0.8 of correlation is very, very high, which means that if the European market goes down, there is a very, very high chance that the Italian market also will go down. So at the end of the day, if I invest 50% of my capital in Italy and 50% of my capital in Europe, where is the diversification there? I might as well invest 100% in Europe, you know? So there is no diversification there. But if I invest in Europe and if I invest in the US, then I have a diversification. That's because if the European market will go down, maybe the US market will not actually go down, okay? That's why they have a smaller correlation than Italy and Europe. Now, when we invest our money, when we choose to invest, there are two types of investments that we can make, two types of approaches that we can choose. One is active investment, the other one is passive investment. Now, if you ask me, the one that I personally like more is the passive investment, just because it requires much less time. Active investment involves very, very much studying, very long studying, very deep studying, a lot of experience, a lot of time even to actually do the investments, and there is also a difference in instruments. When we talk about active investments, we mainly want to go for pure obligation, we want to go for pure bonds, we want to go for pure stocks, whereas for passive we want to go for ETFs, for things that are already packaged and they are there for us to buy. Okay, we will talk about those things later in some minutes. Also, the capitals differ. If we want to go for active investments, we need some big capitals. I'm talking about 10,000, 20,000, just to start. If we are talking about passive investments, we don't need anything. Even $100 every 6 months is fine. Okay, we can do that because we can already diversify. Okay, there are some instruments that help us diversifying with a little capital. In any case, diversification is very important for active and passive. Both. Diversification is crucial when we talk about investments. Okay, that's to reduce the so-called specific risk, which should be around 0 if we could. Now, there are some things that are said about diversification. Some people say that too much diversification gets useless, but there are no drawbacks in diversifying too much. If we do an active investment, yes, we do have to pay a lot of commissions to diversify in, I don't know, 1,000 stocks, 1,000 shares, okay? Not 1,000 shares, 1,000 stocks, okay? But if we invest passively and we buy the S&P 500, which has 500 companies in it, so we buy the index, there is no need to be worried about investing in too many stocks, okay? The more we have, the better. As long as we can pay it a few dollars, okay? As long as we can have low commissions to do that. So when we talk about active, there is a number which is around 2025, which after that there is not much more efficiency, there is not much more increase in efficiency in diversifying even more. So there is that. But if you can do it cheaply, then you can do it even 1,000 different stocks. There is no need to panic. There is no need to say, oh my God, I need to diversify less. Absolutely no. The more, the better. Now, let's talk about products. Well, when we do investments, we need to choose some products, right? When we talk about investments, we have 3 products that are main products, and we do need to know all of them. There are only 3, they are not very complicated, and we are talking about stocks, bonds, and gold. And these are very crucial to know. We must know these products. Now, these products are used in different times, in different periods, and in different measures. When we do active investments, we may want to choose these products varying on the type of circumstance that we are in. When we do a passive investment, we choose the amount for these products that we want, and then we go with that. As a rule of thumb, in every investment portfolio, there should be all of these products, okay? In different measurements, but there should be all of these products, if possible. And therefore, as we are investors, even if we want to just use the independent financial advisor, we do need to understand these products. That's why we're gonna talk about these products in this video. But let's first talk about the instruments, because we cannot invest directly in products. We need instruments that make us invest in those products. As a first instrument, we have the pure stocks. In this case, the product and the instruments, they coincide. And pure stocks are mainly pure stocks. Then we have pure bonds, and then we have certificates, which are a little bit different, and certificates, we will talk about them, but they are used only by specific type of investors, not by everyone. There are ETFs, which are my secret love, ETCs, and then we have options. Also, options are to be used just by specific investors. So let's start with stocks. The stocks are the easiest thing to understand. They are the most used things. They are the most risky thing to use in the financial markets. Well, not the riskiest thing, but the most simply and risky thing, okay? That's why we need a long term, a very long term for stocks, okay? We are talking about 10, 15, 20 years at least. Now, what is stocks? Stocks is simply exchanging shares of companies, so little pieces of companies, okay, if we want. We talked about these things in previous videos, so you can check those out. Now, what is the capital requirement? Capital very low, medium, or high. So for stocks, we have a broad range of capitals. We can go with whatever. Complexity, very low complexity. It's not very hard to understand what stocks are and how stocks work. Risk is medium to low. Maybe we could go to high. It really depends on which type of stocks we choose to invest in, okay? But generally the volatility, which is a measurement of the risk, is kind of high for stocks. That's why stocks are good investments for long-term investors, for very long-term investors. As I said before, 20 years. So very young investors, okay? But the cost, well, the cost is low, but it could go high if we really want to diversify a lot. And these stocks, pure stocks, are for active investments. We are talking about pure stocks. I'm not talking about stocks in general. I'm talking about buying and selling single stocks, okay? Now let's go to bonds. Bonds are, what are bonds? Bonds are loans of money, okay? We give loans as investors to companies or government with the hope that the government or the company will give those money back to us with a certain interest. That's why we get paid, okay? We get paid an interest because we take the risk of not receiving back our money. The capital is medium to high, especially in this period where bond returns are not too high. I would recommend a medium to high capital, just because for low capitals there is not much reward, so there is very no much sense in investing in bonds. Again, I'm talking about single bonds, okay? Single bonds, picked bonds, okay? Pure bonds. So yes, complexity, medium complexity, because there are various types of bonds. We talked about bonds in previous videos in Simple Economics, but there are various types of bonds. There is not one bond and that's it. They work differently. We need to understand the risks behind those specific bonds, and we need to understand the issuer of the bond and the risk of the issuer. The risk is medium to low. Again, it depends on which type of bond. If I buy US bonds, I'm gonna have a certain amount of risk. If I buy Italian bonds, I'm gonna have a very different risk, especially in this period of crisis. What about the cost? Well, the cost is low, but it could be high again because of diversification if you really want to diversify. Again, single bonds, pure bonds are for active investors, okay? Passive investors, stay away from single bonds, okay? There are other much more efficient instruments, which are ETFs. ETFs is my secret love, as I said many times. I love ETFs. Thank God that someone invented ETFs. Buy funds. I don't like funds. I don't like actively managed funds. I love ETFs. What are ETFs? ETFs are simply a basket of stocks or bonds. Stocks or bonds. Okay? Be careful, don't confuse them with the ETCs. What about the capital? The capital is medium to high. Why don't I say low? I said that investments are available to low capitalized people. Well, mainly is because of costs, okay? ETFs cost a little bit to buy. They have maintenance, they have cost of maintenance, okay, the TER, and so it's not very profitable for people that have a very, very low capital. Like, you can buy a stock for $50. It's not advisable because you cannot diversify, but you could. But I would not advise you to invest in an ETF just with $50. Maybe wait, put away those $50 every month, and then after a year, you can invest, okay? So that's why I put medium to high. Complexity, medium to low, it's not very hard, but we need to understand how those ETFs are done and created. Well, ETFs follow indices, they replicate indices, but we need to understand how those indices work and what is inside in those indices. About the risk is medium to low. Of course, it depends on the type of ETF. If it's an ETF that follows a bond index or an ETF that follows a stock index, but generally the risk is very low. If we go, well, of course, stay away from leverage ETFs. There is no need for leverage ETFs. I will talk about leverage ETFs in some other videos, but there is no way to use them in investments. Those are very inefficient instruments. They are not made for investments. Well, in any case, the risk is medium to low, again, simply because of the type of ETFs, okay? The cost is medium, again, because there is a annual cost to sustain. It's not like stocks that you buy and keep it how much you want. ETFs cost every year. They are very, very cheap. We're talking about 0.07, 0.2% every year. For who are the ETFs? Well, for passive investors. Can they be used for active investors? Absolutely yes. But when we use it for active investment, we do want to go for less diversified ETFs. That's just because going for a lot diversified ETFs, there is no reason to be active, okay? You just go passive. But if we go for sector ETFs, well, we want to invest, I don't know, in specific energy stocks or things, then we go for sector ETFs, and those are mainly for active investments. Okay, I would not recommend to go in specific sectors if you want to be a passive investor, unless you say, okay, you know what, I really believe in the technological sector. I think that in 40 years it must go higher. But if we are talking about diversification, you want to go for more broad ETFs, maybe country ETFs, maybe even the world ETFs, especially if we have low capitals. When we have big capital, it's another discussion. We can go for, again, a diversified portfolio, but with less diversified ETFs inside. But for big capital, I'm talking about $500,000, $1 million, $5 million, we should go for an independent advisor. Nonetheless, we should know about these things because we need to know how to communicate with the advisor. ETCs. ETCs are very, very similar to ETFs. We are talking about a basket of commodities, okay? They can be precious metals or actual commodities, but yes, a basket of commodities. Do not confuse them with the ETFs. ETFs are bonds and equity, stocks. ETCs are commodities. Now, there are various types of ETCs. We're going to talk about them when we talk about the costs. Now, Capital, again, is similar to ETFs, medium high, complexity, medium high, depending on the type of ETCs, risk, medium, again, depending on the type of ETCs, cost, medium, wide, depending on the type of ETCs. Now, which type of ETCs there are? There are the physical ETCs or the futures ETCs. Now, I'm calling them like that. Bear in mind that these are not how you actually call them, but to make it easier, there are ETCs that actually buy the underlying asset, they actually buy the physical thing, they buy gold and they store it in their cabals. Or there are ETCs that buy futures, but when they buy futures, they need to roll every month the future to be able to still invest in the asset. Well, not maybe every month. I think every 3 months. Well, anyway, every time the future expires. And because of that, there is the contango effect. Contango is simply the fact that the next future is gonna be more expensive than the previous one. Okay, that's just the effect of futures. It's connected to the storing prices, the storing costs of the goods. Therefore, the futures will have to pay this difference every expiration of the future contract. Therefore, the tendency of those ETCs is going down. There is a very good example with oil. You will see that an ETC in oil maybe can do a 20% in, I don't know, certain times, when another future will actually, or when the actual underlying asset, you can see it with CFDs, which I don't recommend to invest in, but they are good things to watch the prices of things. You will see maybe an 80% increase. Okay, that's very normal with ETCs. ETCs based on futures are for speculators, not for long-term investors. Keep that in mind. Passive or active investment? Passive investment, of course. Active investment, you can directly go into futures if you need to put your money in certain maybe precious metals. One of the options that there is for buying gold, apart from ETCs, is actually buying gold. The problem is that it's expensive because you need to store it somewhere. It's very hard to store it in the house. What if someone comes into your house? What if your house burns down and someone enters your house, or you lose the coins and stuff? So yes, keep in mind that maybe it's better to go for ETCs and not go for actual physical gold. Okay, investment certificates. Let's talk about certificates. Now, be careful to use or to watch for investment certificates, not trading in certificates. These are very, very different. What are certificates? Certificates are a basket of options on stocks. I know, it's kind of complicated. It's a mixture of things. That's why I don't recommend it to people that don't know anything about investments. Even if it's your financial advisor, you need to understand the basic rule of investments. Among the fact that you need to sleep at night, you also need to understand your investment. If you don't know what you are investing in and you are not sure about your investment, it's much better not to invest in that product. Okay? Even if there was an hypothetical perfect investment product that never loses, if you are not sure about that investment, it is much better not to invest your money than to invest your money with you being preoccupied of where your money are. Okay, so that's something to really be careful. Stay away from all those financial advisors that tell you that they know that the financial product never loses, or they know that the financial product is very, very good. Maybe they tell you, oh, it's very complicated. I understand it's very complicated, but just trust me. Trust me, this financial product is very good. Well, stay away from those financial advisors. Always ask for your financial advisors to explain you what the instrument does and how it works. That's why you pay the financial advisor. Okay, so always be sure that you know where your money are and how those financial products work. Okay, so it is much better not to invest your money if you don't understand the financial product. You don't need to understand how the financial plan is constructed and how it is built, actually, because you will need university for that, but you need to have a general, broad understanding of how it works. Capital for certificates, high, even very high. Okay, we're talking about certificates mainly to have some taxation advantages. Okay, they can be used for taxation purposes. Complexity, medium, high. That's simply because they are based on other derivatives, which are options. Risk, very high. That's again basically because they are based on the other derivatives, which means that even if those derivatives change their price or their behavior, they may change their behavior as well, when maybe the underlying asset at the end didn't change that much. Okay, so there are some aspects that play around in the certificates that are very complex. Cost is medium. That's just because similarly to ETFs, there is an annual cost that we have to sustain. Okay, and remember, certificates are used in specific situations by specific investors, not by everyone. If you don't have at least, I don't know, $500,000, there is no need for certificates. And yes, so taxation purposes again. Let's talk about options. Now, options are probably amongst one of my favorite instruments, but not for investment, for trading. We're not going to talk about the trading aspect of options now. We're going to talk just about the investment aspect of options, which I of course don't use. What are options? Well, there are contracts with certain rights and certain obligations. Okay, the capital is very high, extremely high. Complexity also very high. Options, in options we have a lot of financial math, so we need to understand a lot of probabilities, a lot of financial math in general. Okay, the prices of options are influenced by a lot of variables which play around in certain formulas and certain mathematical formulas. So that's also why the risk is very high. That's because we have a lot of variables, and even if the underlying asset may move a certain amount of money, it's not true that the option will necessarily move the same amount of money. The option may move more or less, depends on other variables. The cost is medium, not because there is a annual fee to pay, but basically because when you use options, you want to do something that is called a strategy. So you don't only buy puts or buy calls. If you don't understand what those things are, don't worry, just go and watch some option videos. But yes, you construct a strategy. Okay, you have basically 4 options that you can have using options, and you use them as hedging. Okay, for hedging, you combine those 4 options that you have, and that's why the costs increase. So they are used for hedging on very high capitals. We're talking about $1 million, $2 million, $3 million, $5 million. Okay, passive or active? Active, of course. Okay, passive, there is no need for options. Now, we chose passive investments, we chose ETFs. I'm very happy about it because that's exactly what I do. And how do we start? Okay, how do we choose our ETFs? Well, we can use some website. There are 2 websites mainly, ETF.com, Just ETF. If you're European, go for justetf.com. If you are American, go for ETF.com. Remember that Europeans cannot buy all American ETFs. They can buy some, they cannot buy all. There are some legislations, okay? Just ETF, I'm gonna talk about Just ETF because it's the one that I use and the one that I know. But it gives you the chance to create certain portfolios. You can see the volatility of the portfolio, which is a reflection of the risk. You can do a historical analysis. You can confront different portfolios. You can see which one is better, which one is worse. You can even do a you can even confront and see the differences between 2 ETFs. I explained how to choose ETFs in previous videos, so check that out. And also you can do a risk analysis. For some things, for some things that you want to do, maybe there will be the need to buy the premium membership. But for the basic things that you need, for the essential things that you need to invest your money, there is no need for the premium membership. That means that you can invest for free. Now, let's talk about broker. Bank or broker? If we talk about trading, I'm not gonna talk about trading in this video, but if we talk about trading, the bank is bye-bye, okay? But when we talk about investments, because they are very slow, maybe because we buy an ETF every year, for example, the bank is also okay. What is the major difference between bank and broker? Is the commission fees. Broker and banks have different types of commissions. The bank may have a higher commission for buying an instrument, the broker may have a lower commission, but the broker may want you to buy and sell things on a constant basis. If you watch interactive brokers, for example, they have the so-called inactivity fee, which normally banks don't have. And if you plan to invest, maybe even passively, then there is no advantages in going necessarily for a broker, especially if they charge you inactivity fees. If you are an active investor, then yes, you could opt for a broker. But mainly what you want to check is which instruments can I trade or which instruments can I buy, how much those instruments and how much in general does it cost, and are there inactivity fees, which we talked about in seconds ago, and more importantly, are there any conflict of interest, especially when we use CFDs, which should never be used. Do not use CFDs, but if you fall into one of these brokers that use CFDs, well, do understand that these brokers make money when you lose money. Therefore, there is a very, very clear conflict of interest. All information should be on the website of the broker or in the general contract of the broker. So check that out, please read it. Now, I chose active investments. I don't want to go passive investments. I want to go active. I'm a little bit sad, but that's fine. What do I have to do? Well, I have to study, as we said. I have to study a lot. Where do I start? I start with fundamental analysis. Fundamental analysis is crucial for active investments. We need to choose which stocks are better. We need to choose which stocks are worthy to be bought and which stocks have a very good perspective to grow in the future. How do I choose those? With fundamental analysis. But how do I study, and what about courses? Let's see. So when we study fundamental analysis, we need to understand what fundamental analysis is. Fundamental analysis mainly means understanding the financial balance of the company. So the balance of the company, right? So the quarterly reports and all those things. I don't know much about fundamental analysis because I don't do active investments. I do know a little bit because I do also trade, and because of that I need to understand a little bit of fundamentals. But for doing a very, very in-depth fundamental analysis and very actually good fundamental analysis, we need to study a lot and have a lot of experience, which doesn't necessarily mean that you cannot start investing. You can start investing early, but remember that you will not make money immediately. But how do we do mainly fundamental analysis? Well, we start from the sector. We understand the sector of the company. We understand how the sector is going. We understand the particularities of the sector. Is it a sector that has a very high margin of profit, or is it a sector that has a small profit margin? Is it a sector that needs a lot of debt? Is it a sector that doesn't need debt? And those things. And how is the sector in the world economy? How is the sector doing? And also, does my company have a competitive advantage over other companies in the sector? So, is it actually useful to have that company in that sector in the economy? And of course, as I said before, you need a lot of experience and a lot of study to do a very good fundamental analysis. So keep that in mind, okay? It's not that easy. But if you want to do it, how do you study? Well, first of all, start with the free resources. this video could be a free resource, okay? It actually is for free. Use free resources, okay? That's just to understand if that's actually for you. If it's not for you, there is no need to spend money on books or even courses which cost even more. So just understand it through free resources. Then when you want to learn more, go for books. By the way, be careful with free resources, okay? They are free, therefore there can be a lot of conflict of interests, a lot of shady things, maybe people that want to sell you certain other things, or people that want to advise on certain brokers over others, and those things in general. But so be careful. Then books are not very expensive, $10, $20, $50, $100 a book. And then if you want to learn even more and specialize, go for courses. Courses are much more expensive, but they are very useful. I've done some courses, of course, but for trading, not investment. So unfortunately, I cannot advise you on courses to do. But in general, when you want to do a course on investing, be careful of the scams. As I said before, the financial sector is very easy to have scams. Be sure that the teacher that is gonna teach you have some type of certification or some type of degree, okay? We do need to check the theory that the guy is presenting, okay? If the theory is completely wrong, then there is no way that the guy can teach us something. So be always careful that the guy has certain types of certifications. Certifications do exist. And of course, degrees do exist. And then, of course, an historical proof of the experience of the teacher, which should be at least of 5 or 10 years, okay? So always be careful about that. But even then, we are passive investors. We just want to invest our money. We are not too sure, so we want to go for an independent financial advisor. Even here, be careful of the scams, okay? Financial advisors need certifications. Financial advisors may also need some degrees in some specific countries. There may also be a list of certified financial advisors in your country, so check that out. And be careful to use or to ask for help to independent financial advisors. I know they cost, but you need to go through that, okay? Or if you want to use or to ask help to the bank financial advisor, please do understand that you need to study a lot, because otherwise what they will tell you is that ETFs are crap and that actively managed funds are very, very good and very, very nice. Then they will pop out a 10-year historical proof that fund manager or that specific actively managed fund that they want your money to be invested in is making a lot of money and it's beating the index of reference. After 10 years, you will find out that's not the case and you lost half of your money. We talked about that in previous videos, so check that out. Also, another important thing is that the conflict of interest must be at least clear, even better if there is no conflict of interest. In banks, financial advisors in banks, they do have a conflict of interest, of course. They prefer selling you their funds over other competitors, or even better, selling you actively managed funds over ETFs. That's just because they gain more money. Okay, so be careful about that. And if the financial advisor is afraid of telling you which conflict of interest he's having, then just be bye-bye. Okay, so you should always understand which conflict of interests are there. Now, you want to start investing. How do you start investing? One of the main options that you have, one of the most used options, is to use a accumulation way, okay, a accumulation plan. Well, what does that mean? It simply means putting $100 a month. As I said before, you should not put $100 every single month. It is much better to take those $100, put it away, wait for 6 to 12, 18 months, even 24 months, and then invest that amount of money. Okay, don't wait too much. Maybe 24 months is a little bit too much. Wait 6, 12 months. Okay, that's just so that the commissions are at a smaller percentage in comparison to your capital invested. If you are planning to do active investments, invest a small amount in the beginning, okay? You don't need to diversify a lot in the beginning, but use that small amount just to learn, okay? You will not start making money immediately, it's very hard. And use the compound interest. Don't be afraid of having too few money. Just invest and start investing as soon as possible, okay? And use the compound interest, okay? I started investing personally when I was 17. Okay, and I think I'm very proud of myself, and I think that's a very good example of how soon people can start investing with very few money. Of course, I was lucky for other things in my life, but essentially start investing as soon as you can. But be careful of your limits and go back to the initial slides that we talked about. Then, even if you do passive investments, you are not free from actually managing your portfolio, because you still need to do a rebalance of your portfolio. That's simply because your time horizon changes. Every year your time horizon shortens of 1 year, so you need to rebalance your portfolio, and you need to check if your portfolio still meets your goals and needs and your horizon, your time horizon. Also be careful, because the percentages in your portfolio will vary every year. Let's make an example. So we have a portfolio of 50% bonds and 50% stocks. Very simple portfolio. I'm not saying this is a good portfolio. Don't take this as an advice, but let's imagine this portfolio, and let's imagine that 1 year the stocks go very well compared to bonds. So instead of 50-50, I will end up at the end of the year with 60-40. I don't like that, because I want 50-50. That's why I will need to sell some stocks and buy some bonds to get again to 50-50. That's called the balancing, the rebalance, okay? And then a periodic check is a must. Every 3 months, every 6 months is a must, okay? Even for passive investments. For active investments, that's another story. You need to check it every week at least, I would say. And of course, you need to change your investments every now and then when you find opportunities. Can you make money? Yes, but that's not the point. We said we don't want to make money. Again, it's not true. We do want to make money, of course. That's how we grow our capital. But we want to grow the value, not necessarily make money. Okay, that's not the point. Making money, it's not the point of investing. The point of investing is protecting your capital and make your capital increase in value. And investments take time and dedication, and also, of course, patience. If you invest, you will not become rich. Of course, there are some people that became rich thanks to investments, but unless you have big capitals to invest, there is no expectancy to become rich. Okay, very few people do actually become rich, but you will certainly become more wealthy, which is at the end of the day the goal that we want. Okay, so we want to become more wealthy, we want to protect our capital, we want to increase the value of our money. And also remember the golden rule, not the previous golden rule, a new golden rule that I just invented. Well, it's not that I invented, but just remember that the risk or the profit is proportional to the risk. Okay, so the more you risk, the more you could make money. The less you risk, the less you could make money. Now, there is a whole discussion about efficiency that we could make, because for a certain amount of risk, there are many profits that we could do, and some are more efficient than others, and some are less efficient than others. We will talk about that in a later videos. For now, that is all I had to say for this video. So I hope this mini guide about investments, which is very long, I think 1 hour or so, is been very helpful for you. And I hope you understood a little bit more about investments and why we all need to invest. There is not a person that I see that should not invest their money, unless of course they really don't have the financial support, financial opportunity to invest their money. So yes, I hope this guide helped you in some ways, and if it was the case, please, I really ask you to give a like to this video so that other people can be aware of these facts. In any case, I will see you in the next video.